Hello, welcome to the latest Ingot IP podcast. I'm joined today by Ingot's head of IP services, Ian Goodyer, Dr. Ian Goodyer, to give him his proper title. So, Ian, could I ask you to introduce yourself?
Hi, Martin. Yeah, sure. As you say, Ian Goodyear. Got a PhD many years ago. That's why it's a doctor. So I'm a technical boy by background. Spent many years in academia before going off working in an R&D department for a large company. GE Healthcare, they became. And my job there really was to invent stuff. So that was my first exposure to IP. I was an inventor on several of their patents. So I worked with patent attorneys to help draft my inventions up. After a few years, they offered voluntary redundancy to the whole site as GE was coming to take them over. And myself and a few colleagues thought we can do this ourselves. So we became entrepreneurs. So I come from this as a person who, on the other side, on the innovation side, I set up my own high-tech business, trying to build a non-contact chemical sensor with a couple of colleagues. We filed some patents, trademarks, raised some grant funding, got some investment, managed to build a prototype, get a grant to get it tested. That eventually led to developing a semiconductor-based chip, which a large defense prime paid for the research and development for in exchange for exclusivity in their markets. So that got me used to developing business plans and doing licensing strategy, etc. At the same time, to pay the bills, I was working as a business advisor here in Eastbourne. So as well as doing it myself, I was using my skills that I'd learned writing business plans, etc., to advise others. And then eventually I moved into a business advising full time. So I've been working with Ingot now about 12 years. My focus is on helping companies commercialize their IP. So I have an IP law qualification more recently from Brunel as well, and specialize really in the commercial aspects of IP, not patent attorney work at all, but on how you value, audit, assess, manage, license, make money from your IP.
Okay. And I think you're being a bit modest because you have been named as one of the world's leading IP strategists by Intellectual Asset Management magazine, haven't you?
Yes, for this year and last year, they named me one of the top 300 specialists.
Which is a great accolade. Okay, so at Ingot, how much of the work you're doing revolves around helping clients identify and monetize their IP?
Well, almost all of it, really. I head up the IP services team that does the bespoke work for companies, and that involves, well, it's bespoke, so every project's different, but we do a lot of IP audits where it's a bit like an MOT for your car. We basically go around, we look at all the different assets a company has, test them out, see if there's any problems, just recommendations. We don't do any remedial work ourselves, but we do find the issues. Or we do valuations, IP valuations, bespoke IP valuations. Or we do strategy work, so we help companies license their IP or sort out data or determine ownership of pieces of IP or help organizations develop IP strategies or grant programs or prioritize what patents are the most valuable to them. We do all sorts of different pieces of work around there.
And am I right in saying that work is for commercial clients, from tiny companies, SMEs, all the way up to global international companies? but
Yeah,
also for universities, government agencies.
absolutely. Yeah, the whole suite. Yeah, yeah. We've done work with several government agencies in the UK, and also worked with various international bodies as well. Intellectual Property Office of Singapore. We've developed training materials for those and done some market research for those for them as well. Uh, done various pieces of work for UK government as well. Large companies, multi-billion pound companies with thousands of patent families, all the way down to a one-man band.
Right. Obviously, can't really get you to talk about any of the clients by name because there's a lot of commercial confidentiality, right?
Yeah, that's right. There's a few that you'll find on the Ingot website that have allowed us to do case studies on them, but yeah, most of them like to remain anonymous.
Okay, fine. So, how much of the work you're doing with these people, with these clients, is about helping them get a better return on their investment in their IP and related intangibles?
I think all of it is fundamentally that, Martin. We specialize in helping companies monetize their IP. We're not patent attorneys, so we're not about, the number of patents that a company
Right.
has or extending out without a strategy behind it. So it's really all about optimizing the amount of value you get for the amount of money you spend.
So laser focused on using IP to raise money for the company, but also presumably to use IP in funding. Is that right?
Yeah, yeah, to use it in funding and to use it to create product and increase sales. Absolutely. Yeah.
Okay. So kind of funding that IP could be valuable in. Do you want to just run through how you could use IP value in raising funding as a company?
Yeah, absolutely. Obviously, in the early stages, before companies got to turnover, they're mainly going to be funded by themselves by doing consulting work or um, or by friends and family, and perhaps by your government grant.
Hmm.
And then as they mature a little bit, they may get some equity funding from a stranger, from a business angel.
So we've looked at equity funding,
Mm.
and you were then going to mention something else. So I'm sorry.
Yeah. So as a company gets bigger, banks become more important, and lenders in general. So traditionally, banks have been very keen to lend to businesses that are profitable, that have IP that's generating a nice, healthy profit. Ingot, a couple of years ago, started to work with NatWest Bank,
Hmm.
and they have begun to shift where you can get funding down to scale up. So companies that they need to have some revenue. They need to be earning money from their IP, but they don't yet have to be profitable. And NatWest, um, forward-looking bank as they are, um, now lend, taking the IP into account and taking the charge over the IP rather than personal charges.
Okay. So basically, that's quite an important development, the use of IP actually as collateral in bank lending, correct?
Absolutely, yeah, yeah. I think it's a world first. There's lots
Right.
of around the world. There's lots of pilots going on at the moment trying to replicate this, but I think it was the first.
Many of which Ingot is involved with, I believe.
Absolutely, yeah.
Yeah. So the point about the NatWest loan offer, of course, is that it's arguably the world's first loan that specifically targets growth SMEs. It's always been possible for big companies, of course, to borrow money because Edison did it against his light bulb patents, but SMEs have always found it more difficult to do.
Yeah, it's
Um,
scale ups is the term, Martin.
yeah,
So as a company reaches scale up stage, which is where they've got turnover, they're
right.
growing quite a large percent every year, 10-20% each year. They're just on the bottom of that hockey stick, that classic
Yeah.
hockey.
Okay. Is there, I mean, why haven't banks been happy to lend against IP in the past? Do you know?
I think, yeah, there's several reasons. First of all, they haven't really understood IP. You know, there's something about being able to kick something. You know, having a physical building, might give more for than a piece of paper, a patent or trademark piece of paper. So banks haven't really understood it. There's concern also that the IP might not be worth so much if a company goes bust, because it may be the brand may be damaged if a company goes bust, or the patent may be so technical that if the inventors have disappeared, it's of no value. Uh, that might be a bit misplaced, actually. There's been quite a lot of research showing that most bundles of IP that financial institutions get left with after a default do get sold. And quite often there are things that get sold first. If you think about, the Debenhams trademarks and the Debenhams buildings, everybody knows around the UK now. The trademarks have been sold and gone, and the buildings are still sitting there empty. So quite often IP does sell faster, but that would not be the common conception.
Right. But it does look like when a company's in trouble, quite often the IP is one of the more valuable things that people are
Absolutely, yeah.
looking to buy.
Yeah, I mean, typically in one of these companies, 89% of the value of a company is in intangibles
Yes.
when it's trading, and so you expect a lot of the value left when a company goes insolvent, will also be in the IP, and that does seem to be the case.
So, Ian, you've obviously got a lot of experience yourself. You are an entrepreneur. You've advised many other entrepreneurs and bigger companies. So when we're talking about funding for growth, or a lot of the time, equity is a default setting. Why do you think that is?
Well, traditionally, it's been the only option until companies are profitable, Martin. And even now, I mean, equity investors are in it for a long term. They put their money in, they get a percentage of a company, and they cash out if and when the company makes it. So it's risk capital, basically. And at an early stage, risk capital is the appropriate thing to use.
But is it always the right choice to make at the right time? I mean, do companies make mistakes in choosing a funding route?
Yeah, I think certainly now that NatWest are offering these IP-backed loans, a lot of companies, maybe they don't appreciate that these loans are available, or I think it won't apply to them. And so
Right.
they don't consider IP-backed lending at a stage where they could be eligible for it. They seek equity, which obviously is a more expensive, dilutive form of funding.
Right. And that word dilutive, I mean, obviously, anyone watching this who's got any experience of raising funding for a startup, they'll understand what it means. But if you like, do you want to explain for anyone out there who is literally starting up a startup what dilutive means?
Yeah, well, obviously, every time you raise equity, you give away some shares. So you give away a percentage of your company. So a percent that you as the founder own goes down. So you're what's called diluted. If you set up a company at the end of a day for £10 million and you own 100% of it, you get £10 million. But if you've given away 50% of equity, you only get half that, obviously. So you get diluted down. And then
Right.
if you compare it with debt funding, where a bank or somebody lends you money, if you pay it back, and then your company sells for £10 million, you get rid of the whole £10 million. You're not diluted down. So it's a
So
lot less.
this is,
In the long term, it can be a lot less expensive to get debt funding.
but this dilutive equity is what we're seeing on shows like Dragon's Den, right?
Yeah. Yeah, the dragons are the equity investors.
Talking about dilution, then it is a major cost that people with IP need to take into account, but it's not perhaps an obvious cost. Is that right?
Yeah, I guess so. I guess that people who are starting up a tech company expect to have to give some equity away, and maybe they don't know how much they have to give away, and they might be surprised at how much. They might have to keep coming back for more equity funding if the plans don't go as fast as expected, or there's some technical hitches.
Okay. So is that why it's a good idea to make sure that you get your IP valued right at the start?
Yeah, IP valuations are very important. We do a lot of IP valuations for companies looking to raise equity funding. It's very useful because it makes sure that the company doesn't give away too much equity too early on. It gives them
Right.
grounds where they can negotiate. Our valuation reports contain lots of detail about previous deals that happened, previous licensing agreements that have happened, what the value of the IP is worth in the company, and that allows a more nuanced negotiation with your equity funders.
Okay. So if you can get hold of non-dilutive funding, what kind of businesses are likely to benefit from it more?
Yeah, so it's as I've already said, the company has to have some turnover, so they have to be large enough to be, for their IP to actually be earning some money now. But as for the type of business and the type of IP, we see all sorts of companies getting IP-backed lending. So purely software businesses on one side, businesses that use a lot of data, businesses that have patents, um, and yeah, so the whole suite of different IP owning businesses.
Okay. And looking at some of the case studies we've got on the sites, quite a lot of those companies are actually have, as you said, patents, but they're working in engineering. They've got designs for new products. So there's a whole gamut of different kinds of
Yeah,
IP.
all the way across from the green sector through to biotech. Absolutely.
Right. So how does IP play a role in enabling companies to access non-dilutive funding, and kind of where would that work best?
Yeah, so it allows companies at an earlier stage to obtain non-dilutive funding. It allows companies to have to give away less equity in the long run if they have IP. And the reason for this is because the banks can take a charge over the IP rather than taking charges over. Well, quite often for a small business, there isn't anything else to take a charge over at all. They don't want to take a charge over a director's house if they can avoid it. It looks terrible for a bank if they have to call that in. So it's much better if they can take a charge over the company's IP.
So in essence, it kind of changes the funding equation, being able to use your IP as collateral, because
Absolutely, yeah.
yeah.
And it allows a bank to lend at relatively low rates as well. I think NatWest have stated publicly that they lend at 3% over base for most of these businesses where they're doing the IP loans.
Yeah, I think that is something that they have said. Um, it's on average at 3% above base
Yeah,
rate.
yeah.
Yeah. Okay.
You won't find a better loan, I don't think, a less expensive loan.
People like yourself, with a background in biotech, um, inventors, patent holders, and so on, at some point, they're going to need to bring a chief financial officer on board. And
Mm-hmm.
how do you talk to chief financial officers? Because isn't there a slight difficulty that they may, that CFOs may actually not fully understand IP and IP value?
I think it depends on the CFO, Martin. I think traditional accounting training doesn't emphasize IP as much as maybe it should in the past. But with some of the CFOs that we meet when we're doing these IP valuations, obviously they're specialising in being CFOs for techie companies, so they have more of an idea, and they're also very aware of how much they're spending on their IP. Obtaining IP isn't always inexpensive. If you take all the R&D costs involved and cost of filing, it can be quite inexpensive.
Right. So in an IP-rich company, the CFO will tend to be actually pretty clued up on intellectual property, and will see it as a valid something that can be used to generate extra value for the company, but also to explore using in a funding route.
Yes, I think so. Absolutely. Yeah.
Mm.
Yeah.
So you've dealt with a lot of CFOs. What questions do you think they should be asking when they're exploring a funding route?
I think they should ask how much their IP, the IP in their company is worth. They probably have an idea of how much it's cost, how much has been spent by the company in acquiring it. But that isn't necessarily always the same as the value to a company. In fact, it rarely is. People don't normally spend money on R&D for it to be worth what they've spent.
Right.
There wouldn't be much point bothering in that case. So normally the value of the IP is a lot more than the cost it's taken to acquire it. And CFOs probably need to, along with the rest of the business, appreciate that the value can be significantly more than that. When we do a valuation for NatWest using our Solomon tool, it looks at value from a number of different angles. It looks at the cost of production and also future income that you might obtain by owning the IP. And it comes with sort of a blended value. And then we have a second tool, which we call Hallmark, which works out sort of a loan to value ratio. So you know how, similar to it when you get in a mortgage, you know what sort of percent of the value of a house can you lend
Right.
against.
Okay. And the bank will effectively take a haircut on the value so that it's now lending an amount it is comfortable with.
They'll lend against a proportion of the value that we've found, yeah. And the value is a blend of the different valuation methods.
Is non-dilutive funding ever the wrong choice?
Yeah, it's a good question, Martin. I guess at the early stages of a business, it isn't available.
Because of no turnover.
Yeah, because there's no
Yeah.
turnover. The bank can't be sure it's going to get its money back. And it's not sure that the IP is actually going to actually generate a revenue in the future. It might be some technical hurdle or market hurdle or IP hurdle or whatever that prevents it. So then it isn't appropriate, really. It's possible. At a later point, it's really a strategic decision whether you go for equity funding,
Equity or debt.
or debt-based funding. Yeah.
Right. Fine.
Or blend of both. There's something called venture debt, which is often where the two are combined.
Are there any obvious reasons why a lender might not actually accept different kinds of IP as collateral?
We've seen a few different situations. So I guess the most obvious is if a company doesn't own the IP. Quite often, for example, there are quite technical companies that have spun out from universities, and they've got a license to the patents from the university rather than actually owning them themselves. So obviously, the bank won't be able to take a charge over the patents that the company doesn't own itself.
Ooh, okay.
Another ownership issue we quite often see is with software companies where they've used contractors in the past. And the default, I don't know if you know, but the default situation when you use contractors is a contractor owns the IP unless there's some contract in place that assigns the rights over to a company. There will be due diligence done to make sure that the IP is owned by the company. That's what we do in our audits.
Right.
But it's also something that the bank will do as well.
Okay, so that would particularly apply to databases, software, and anything that might be protected by copyright. Is that right?
Yeah, that's right. Yeah, primarily.
And if any company that hires an external expert or an external expert company to do something like that for them needs to make sure that the contract makes it clear.
Yeah, it's relatively simple, but you need to make sure a contract says that the company owns it once they've paid. And if it doesn't, there's remedial things you can do. You can get a past copyright assignment. You can basically get the contractor to sign it over.
And this is something that you've come across with a number of clients and you've advised them to go off and get the right paperwork.
Remarkably common. Yeah.
Okay.
Another reason why a bank might
Yeah.
not take the IP as a charge if there's already some sort of general charge over a company as well. So this isn't really a problem with the IP. It's a problem with the historic financing of a company.
Right. Because previous lenders may have taken a general charge on all company assets, including intellectual property.
Yeah. And obviously the bank will want to carve out and say, well, you can have everything, but we want first dibs on the IP. And obviously the previous lender can agree to that.
Yeah. And that's because a floating charge as opposed to a fixed charge on intellectual property, if you've got a floating charge, then you aren't necessarily first in the queue if there's a problem because you're behind HM revenue and customs. But if you've got a fixed charge, then you're at the head of the queue when it comes to that particular asset. Yeah. If there's one thing that business leaders should rethink about how they use IP and funding, what should it be?
Well, I think if a company has IP, it should start factoring in obtaining non-dilutive debt-based funding earlier in its journey where maybe it did traditionally. Pretty much as soon as it's had, a couple of years of revenue growth, before it's even a profitable company, it can get debt-based funding now from NatWest, or at least there's a possibility it can. So it should be considering that as an option, I think.
Okay. So they may have been looking to bring IP in to funding at a much later date, but now there are routes to using IP as collateral for lending. Not necessarily from IP, of course.
I think it may be banks traditionally haven't lent against IP. So SMEs probably aren't even considering debt-based funding in the early stages until they're a profitable, thriving business.
Okay. But now they can. And as they used to say on the BBC, other products are available. I understand that there may well soon be other banks that are doing similar.
Yeah, we're talking to several UK high street banks, and also working in Malaysia with banks as well, in Singapore.
All right. Okay. So to wrap things up, Ian, I think what we seem to be talking about here is a quite rapidly evolving IP-backed lending landscape, which arguably is significantly changing the whole funding strategy, particularly for IP-rich companies. Would you agree?
Yeah, I think it's been a major shift. So back in 2011, 2012, I think. So back in the dark ages almost, UK government was asking the question of why banks weren't lending to high growth, high tech SMEs. They were already aware that these companies had the potential to grow the fastest, employ most people, pay most tax, export the most, survive the longest. You know, they were the bright stars, and the financial services industry was essentially ignoring them, and not lending to these companies until they were successful. And so the government asked why that was. Our CEO Martin Brassel co-authored a report called Banking on IP. He basically interviewed all the people in the city, asked why they wouldn't lend to these businesses. What was the barriers to entry, and it's been his life's work ever since. It's been 12, 13 years of slog to build the tools that the finance sector needs to give them comfort to lend to these companies. It's been a lot of intellectual effort and sweat and blood and tears to create the products that the finance sector requires.
So it looks a bit like IP finance is being adopted in Southeast Asia faster than it's being adopted in the UK.
No, I don't know. I think NatWest is still a leader, because they've actually done some deals, in the UK.
Yeah. I don't have the figures for exactly how many deals, but I do know that they've announced that in the 2 years of the loan being available, they've lent £27.5 million,
Mm-hmm.
with an average loan of about 730,000.
Yeah. So we probably should make that point as well, Martin, that this is relatively small amounts of lending to small companies. There has traditionally been IP-backed lending for larger companies for larger amounts, particularly in the USA. But this really brings it down to the early stage smaller companies, which is a game changer, really.
And in the UK, it's estimated that there is a funding gap for scale-up companies. I think it was calculated 5 years ago that funding gap was 15 to 20 billion a year, and it can only have got bigger since then. And there's been lots of figures from places like the European Central Bank that suggest that the funding gap in Europe is also into the hundreds of billions. So it does seem as if IP-backed lending could be a viable solution to that challenge.
Yeah, I think that a problem's been identified. I think that these high-tech, high-growth SMEs, IP-rich startups aren't getting the funding, the non-dilutive funding that they require. So they end up having to either dilute down the founders, or they don't receive the funding at all and don't succeed. I think that's fairly well established now that there's that issue, and if we can produce the tools that provide the solutions for banks, and that could really unlock a whole load of growth potential.